Spencer Gray's posts on the NMHC Strategies Conference 2025. He summarized it with ChatGPT 4.0. Some of the stuff that Spencer has identified here really isolates some very interesting things that are happening at NMHC. So one, people are acknowledging the regional performance of the Midwest and Northeast. Sunbelt markets face this oversupply challenges. That's not really a revelation, but it is important to note here. And I think that it's interesting. The workforce housing demand remains strong. I think this is going to be interesting because of the way that new supply affects the market, and people say, well, we need more workforce housing, but the way that new supply comes in and it will affect the rents in a cascading way, the B class, C class, and all that, those rents are going to come down. And what happens what has happened in the past is I've heard these discussions, and there was one on Spencer had with a few multifamily investors on Marcus and Millichap's 2025 forecast web conference, or maybe there was an Outlook, I forget. But they talked about how some of these C-class assets may not have buyers, or maybe the distress will be in like older buildings that are maybe a little less shiny and new, or maybe a lot less shiny and new, and it'll be difficult for them to find a buyer. I wonder how that's going to shake out. If they're not already a sought-after asset, how much that's going to move the market, or will it encourage investment from people that typically have nicer assets? They just see those prices so low and they're willing to invest.
Yeah. The distressed word that's thrown around it could mean one of many things. It's like maybe you have no buyers for your asset, or maybe you financed it wrong, or something is going wrong, and people just kind of throw distress out there to mean any number of things. But I mean, I can see it even from us. We don't really consider too much C-class stuff anymore. Really ever have. Yeah, I mean, it makes a lot of sense.
It is interesting too. Yeah, what you said about distress and how there's not necessarily like a textbook definition, and there's also things that are just distressing.
Exactly.
And that's going to happen the same time that you have like whatever technical definition of distress is. I do think that it's interesting. There's a signal maybe that interest rates, debt payments, loans, lending environment, all of that is going to create a problem perhaps for people that currently have loans for multifamily. It's a small subset, but I think that they could be under stress while they're also under distress.
Yes.
So capital market, they're talking about institutional equity largely sidelined. I think that this is interesting. Again, this is another follow-up question for Spencer next week is about foreign capital. I think we already have seen private capital stepping in terms of maybe individual investors or smaller investors than the big guys with the funds and everything. They said debt is liquid, underwriting more cautious. Definitely have seen that. We're fairly disciplined as well. I wish we were less disciplined, and so we could have a bunch of deals. But unfortunately, we are disciplined, and we find our few really great deals that we go on to market, and we get investors for them, and it's working out pretty great for us. But there are some institutions that aren't finding a single one. I'll talk about this in a few minutes here when we cover some more articles from Marcus and Millichap. But the idea of dry powder is always like so weird. It's like there's always been dry powder. It always seems like everyone's always talking about the enormous amount of dry powder, and I never see it really go anywhere. It's always like earmarked for like this super special condition of like super returns.
Yeah,
and so
exactly.
It's not really.
That never ever really happens.
Yeah. And I like the acknowledgement there that this institutional equity is largely sidelined because it's sidelined. It's either going to act or it's not. Don't tell me how much dry powder you have. Tell me if you're going to use it, because it might as well be flour or whatever. I don't know.
And it seems like people talk about dry powder a lot, and when you have the hindsight to be like, oh, that was the bottom, I should have gone in, it's too late. You know what I mean?
No, that's a really, that's a good point.
Like, I think for most people, it makes sense to always be investing.
And I think too, I wonder if the dry powder, it's not like it's been sitting there for 3 years. It's cycled through. Right. It's, there's just a surplus. Development challenges, that's something that we will also be tracking here. There's a great chart from Fannie Mae that shows how how in the wake of this reduced permitting, how the deliveries may be falling off to the levels of like 2014 and 2015 in as soon as Q3 of this year.
Yeah.
So that's like a big fall off in building. That's going to translate to a little bit stronger asset performance. I don't know what the lag time is, so that's going to be interesting.
I wonder if we could give each year like a theme of in the multifamily space, and in 25. I don't know what it would be yet, but 24 definitely seems like the loans are getting reworked, things are getting pushed down, which is kind of the same as 23, pushed down the road a little bit. In 26, I feel like this is looking pretty far ahead, but it could be this supply and demand shift because the demand is just incredible. I mean, we've seen insane demand in 2024 for multifamily housing, and exactly to what you're saying, as development kind of falls off a little bit of a cliff or kind of goes down to a trickle. I think 2026 might be, that might be the theme of 26.
That's a good point. Like we'll be firmly in like a kind of new landscape. All of the articles that we're going to be covering here, they reference something more or less like a balancing of supply and demand. So we'll probably like crest that hill, and then we'll be firmly in it. Once we're in 2026, it'll probably be a unambiguously strong rent growth, barring any kind of economic slowdown. So. Yeah. When it comes to value add and distress, like we were kind of talking about, pre-2000s assets face skepticism due to high CapEx and tenant migration to Class A. But in the best opportunities, mismanaged assets in strong location. Notice that they don't say like Class C assets or older assets. It's just maybe good assets that are mismanaged. I think that's a good case. However, like I don't have a compass or a dowsing rod that shows me which apartments are mismanaged.
I like this phrasing specifically, like use pre-2000s assets face skepticism. So it means that there is still good deals that are older and maybe B or C class in the 80s and 90s, but it's just you have to look at that with an increased level of skepticism for sure, which is, I like the way that this is, ChatGPT framed this, or the way that Spencer framed this.
Maybe that went through, maybe he wrote skepticism and they kept that, who knows. I was just going to say, good job, Chat. Good job, GPT. And then also regulatory risk with rent control and tax policies as wild cards, and they're talking about prioritizing landlord-friendly states and tracking local policies carefully. This could be interesting. I think that there's also obviously regulatory risk on the federal side, or deregulatory risk, however you kind of want to put it. There's a lot of uncertainty there, and I don't want to say it's not worth talking about, but it seems like it's just generated a bunch of question marks and uncertainties at this point. There's not a clear direction like there is with apartment supply, or even really, I think there's a compelling case to say like inflation, it's generally trending down, despite like a couple ticks up. There's ways I understand that more than I understand the policy directions right now. That's like 10 working days into the Trump administration.
I like a lot of the framing of, I guess, this post and the words used, major wild cards, because I would think with a new administration too, I would actually think that this risk would be less prevalent as it might have been in the previous administration. I agree too. I was going to say like I don't think that there's going to be more restrictive rent control or more restrictive tax policies, at least on the federal level. Now maybe they could have there could be like some kind of reactionary thing by local governments making other policies, but I don't know. That remains to be seen too. Big uncertainties. Pretty big wild card. And then their bottom line, I don't like a year for selective disciplined investing, focus on markets with supply demand imbalance, alternative capital structures, and operational efficiencies. I don't know. That's a little too general, but it's okay. I would love now. Again, this is not. I don't have ChatGPT in front of me, or at least the training, the notes that Spencer used. But I'm most curious, and this question will come up, and I'm sure I'll be thinking about it throughout this episode of the Gray Report. What's the difference between this year and 2024? So much is the same, and only recently it seems like things have seeming more the same than they were. So maybe later in 2024, when we were a little bit more optimistic about 10-year treasuries being lower. It's like it's going to be clearly better, but now we're facing some very similar
pressures from interest rates as we were in 2024. However, on 2025, the supply demand, the market fundamentals of the multifamily market have unambiguously improved.
Right.
There's no way around it, and you can look at the trends. Trends are pointing in the right direction.
Yeah, it seems like 25 is somewhat similar in terms of like the interest rate environment, maybe a little bit worse, but the supply demand metrics that you talked about seems like right now it's going to gradually get better towards the end of the year, at least for the sponsor side.
Now, this is a question because you talk to investors a lot. Where do you see it falling? Do you notice any? Because we had a deal, I think, right, in early 2024.
Mm-hmm. And we close in April.
Yeah. So we closed in April. So I'm curious, how does the sentiment from investors today differ from
24?
Yeah.
I think it's maybe mostly the same with just a one tick more skepticism, I think, or want to dig through all the numbers a little bit more, which is totally fine. We're happy to provide that kind of thing, but I think they just want to think that they're being more thoughtful in their due diligence of investments, which is, I mean, you should always do that for any investment. While really 2022 was the year that real estate's going up, it's gone up for the past 2 years, it's going to keep going up, and people were just kind of throwing money into every deal, not just ours, but all kinds of deals. And it seems like it's just a little bit more thorough, I guess, in the investing from the conversations that I've had.
Yeah. Okay. And that seems to be it's this kind of qualified optimism,
which I think is a good thing. As an investor, you're putting $100,000. You're putting $100,000 into something. You should probably know it for sure, at a pretty deep level.
And I remember going over the numbers in 2021 and 2022 when rent growth was growing like crazy, and thinking okay, something is a little bit wrong here. There's something that's out of whack, and valuations started going up like crazy, and you kind of get this sense as all right, this is a little bit detached.
Right.
But now, and much as probably as it will be in 2025, I think fundamentals may improve, may make things a little bit easy for apartment operators, but on the buying side, the sales volumes could be very similar, which is annoying.
And actually, the other thing that I just thought of, I had a few of these conversations with investors that have actually told us that they are holding off because they are holding on capital for capital calls from other deals from sponsors.
Oh,
that aren't necessarily going that well, but they're not totally kind of, writing to zero or just kind of kicking to the side, that they are still kind of hopeful that the project will work out long term, but they need to retain capital in the event that the sponsor calls them and said, hey, we need a little more money for this, or reach out another 12 or 14 months.
So that's interesting, and that also implies, a more pervasive sense of realism about where the market is at, and I wonder if that's going to translate to lower asset prices. However, all of the reports, I couldn't find a report that has that is contradicted it. All the reports suggest cap rate compression, but maybe in these select opportunities, you could see someone that's motivated. That's because people are accepting maybe there's not going to be a quick fix to this.
Yeah.
We've lived with high interest rates and kind of difficult times relatively for the past couple of years.
One of the things I hope happens this year is that there's a continual divergence amongst really good quality sponsors and the sponsors that kind of threw money at anything in 21 and 2.
That's
it seems like that is happening, and a lot of the LPs are getting really frustrated with the properties that aren't distributing. That they've put money into in the last 3 years or so. And I think that certain sponsors are going to start to get a negative or a more poor reputation, which I think that there should be a more clear way to kind of gauge the quality of a sponsor.
Well, because I thought about this, and maybe I've discussed this on the Gray Report, is there are plenty of people there are plenty of investors, and you get a bunch of investors by promising very good returns unrealistically, but maybe you believe them or maybe you not, and you get a bunch of investors. Turns out the investment doesn't go great, but people say there's this P.T. Barnum kind of thing where you don't want to admit that you're the victim of being a sucker. But I also think that the length of a multifamily investment period is such that you may not know that you're a sucker until closer to the end, especially if you're going to make money on the sale of it.
Yeah, and it might not be the sponsor as a whole. It might just be a couple deals that maybe they didn't put as much due diligence into as they should have.
Yeah.
And I think most of them know certain decisions that they might have made that were maybe less than ideal. But I think I think they're kind of pushing it down the road in terms of talking or communicating to their LPs because it hurts them for raising capital for newer deals that they might have.
Yeah, yeah.
And so, you don't want to say,
that's what I'm hoping.
Hey, these projects aren't distributing; they're not going well. They're, maybe you'll get your preferred return back, maybe, but you want to do $100,000 into this other deal that I have in Texas or whatever.
Yeah, yeah.
And so, yeah.
No, that's a good point. And this is the one that really caught my eye. It was earlier. Spencer made this post, said, there's a vibe shift at NMHC this year. Talk is not whether there will be distress, but how to navigate. Seems to be darker. Because I like this dramatic quote. Seems to be darker. It always does before the dawn. I do agree. Like that colored my whole approach to the notes, and as I was gathering sources and stuff, and so maybe there is a little bit of a bias, but it's clear that there has been a perspective shift from later, maybe let's say Q4 2024, and now we're in Q1 in 2025. It's like I think I wrote it in the notes, like from late fall of last year to like the winter, things gotten a little more chilly for the multifamily market, but I also think by focusing on all of that, I want to kind of to front load this a little bit, and as a way of saying, all right, so we kind of know the bad stuff, then we can get to the real good stuff.
Yeah.
And it's not, and I don't think that they detract from each other. There's lots of good positive stuff.
It's not even the bad stuff. I mean, it might be bad if you're an LP that's in some of these deals, but it's really just like being transparent on what is happening out there and kind of, showing the landscape of the multifamily space. And it just kind of, it is what it is, kind of.
Yeah, I agree.